The starting gun for the institutional takeover of Bitcoin has been fired, and almost nobody heard it. While the world was watching the markets, a quiet revolution was happening in the halls of Washington, D.C. federal regulators, namely the Office of the Comptroller of the Currency, have been steadily building a regulatory bridge for the biggest banks in the United States to march directly into crypto. This isn't a future prediction, it's happening right now, and it represents a massive shift in the landscape of crypto, perhaps the biggest since the launch of the Bitcoin ETFs. The old game is changing. The institutions are no longer just knocking on the door, they are building their own house inside crypto, and they want you to move in. But the rent they might charge is your freedom. This changes a lot of what you thought you knew about the next market cycle and the future of your money. So, what exactly happened? While most of us were distracted by price charts, the primary regulator for national banks in the US, the Office of the Comptroller of the Currency, OCC, was methodically laying the groundwork. This wasn't one single event, but a series of interpretive letters, dense legal documents that quietly rewrite the rules of the financial system. It really started back in July 2020 with Interpretive Letter 1170. This was the foundational step, which first confirmed that national banks could act as custodians for crypto assets. Think of it as the OCC telling banks, yes, you can be the vault for your client's Bitcoin. Over the next few years, more clarifications followed. But the real accelerant came in 2025, capped off by Interpretive Letter 1188 on December 9th. This letter was a critical piece of the puzzle. It confirmed that national banks can engage in what are called riskless principal crypto transactions. In plain English, it means a bank can act as a middleman, buying Bitcoin from one customer and instantly selling it to another without ever having to hold the asset on its own books and take on price risk. The OCC itself said this makes the bank's role similar to a broker. When you put these rulings together, you don't just have individual letters. You have the deliberate construction of a framework designed to usher banks into the crypto market. Perhaps most significantly, other guidance in 2025 began to walk back a previous, more restrictive stance that required banks to get a supervisory non-objection before starting crypto activities. While banks must still conduct all activities in a safe and sound manner, this change lowers the barrier to entry. The message from the primary US banking regulator is getting clearer. The doors are opening for business. This isn't just a theoretical legal change. The banks aren't waiting. They are already starting to march across that regulatory bridge. One of the first to make a major public move is PNC Bank. In a landmark announcement on December 9th, 2025, PNC, one of the top 10 largest banks in the US, launched direct spot Bitcoin trading for its private banking clients. They didn't build this from scratch. They partnered with one of the biggest names in the US crypto space, Coinbase, using its crypto as a service platform. Think about what this means. A high net worth individual no longer has to sign up for a separate exchange and figure out a new, unfamiliar system. Now they can just log into their PNC private bank app, the same one they use for everything else, and with a few clicks, they can buy, sell, and hold Bitcoin. It's seamless, familiar, and integrated directly into their existing financial life. This is the bank's masterstroke. They are selling convenience and safety. And for millions of people who have been hesitant to enter the crypto space, this will be an irresistible offer. But here is the catch. This is the Trojan horse. The Bitcoin you buy through this model is not the Bitcoin that Satoshi Nakamoto envisioned. It's Bitcoin on the bank's terms. And those terms likely come at a very high price, your sovereignty. When you buy Bitcoin on a banking app, you almost certainly don't get the private keys. The bank doesn't even have them. They are likely held by a sub-custodian like Coinbase. You don't own Bitcoin, you own an IOU from the bank, which in turn owns an IOU from its custodian. You are at the end of a chain of liabilities. The announced functionality is limited to buying, holding, and selling. There's no mention of withdrawals. This is critical. It is highly likely you won't be able to send that Bitcoin to your own self-custody wallet. It's stuck inside their system. This is the Hotel California model of Bitcoin ownership. You can check out anytime you like by selling, but you may never be able to leave with your actual coins. This structure reintroduces the very problem Bitcoin was created to solve: counterparty risk. If the bank or its custodian faces financial trouble, what happens to your Bitcoin? In a bankruptcy, you are not the direct owner of a bearer asset. You are an unsecured creditor, and you have to get in line. The banks are building a beautiful, convenient, gilded cage. They are making it easier than ever to get exposure to Bitcoin's price while quietly stripping you of the true ownership and control that makes Bitcoin revolutionary. If you're starting to see how critical self custody is in this new world, but you're not sure where to start, I've linked my complete guide to the best hardware wallets down in the description. It's not sponsored, it's just the gear that I and many others in this space trust to secure our assets. Take a look after you finish this because what I'm about to share next is the other side of the bank's apparent game plan, and it's far more aggressive. What we appear to be witnessing is a coordinated two front effort by the traditional financial giants to co opt and control the Bitcoin ecosystem. The first front is the one we just discussed, controlling the on ramps. The model we're seeing is the blueprint. The goal is to make the bank custodied, no withdrawal version of Bitcoin the default option for the masses. They will market it as safe and easy, and they will capture the next wave of adoption inside their walled gardens, effectively neutralizing the threat of a parallel sovereign financial system. But it's the second front that seems more insidious. This front appears to involve undermining the free market alternatives that currently exist, and a prime example is MicroStrategy. For years, MicroStrategy has been the go-to vehicle for investors wanting Bitcoin exposure through the traditional stock market. By holding a massive amount of Bitcoin on its balance sheet, the company's stock became a de facto Bitcoin proxy for anyone with a brokerage account. But the big banks may view this as a threat. Throughout 2025, some analysts, including those at JP Morgan, have been issuing warnings about a significant risk facing MicroStrategy. They've highlighted that major stock index providers, specifically MSCI, are reviewing their rules for inclusion. The question being debated is whether a company like MicroStrategy, which holds such a high percentage of its value in a digital asset, should even be included in standard equity indexes. Let me spell out the implications. If MSCI decides to exclude MicroStrategy from its major indexes, it could trigger a cascade of forced selling. All of the giant passive investment funds that are required to track these indexes would have no choice but to dump their shares of MicroStrategy stock. Some analyst reports have suggested that an exclusion could trigger forced selling of billions of dollars. An outflow of that magnitude would almost certainly impact the stock price and could create immense negative sentiment for Bitcoin itself. Now, you have to ask yourself, why are some of Wall Street's biggest players, who are simultaneously building their own crypto offerings, so loudly highlighting the potential downfall of the biggest Bitcoin proxy on the market? To many in the crypto space, the answer seems obvious. First, you control the on-ramps. Second, you challenge the competition to ensure that when people want regulated Bitcoin exposure, the only game in town is the one you control. It's a potentially brilliant and ruthless strategy to corner the market. This institutional invasion isn't just changing who holds Bitcoin, it's fueling a debate about whether the very rules of the market are being rewritten. For over a decade, Bitcoin's price has been famously defined by the 4-year halving cycle. This predictable supply shock has historically kicked off a massive bull run, followed by a gut-wrenching bear market. It was a violent but somewhat predictable rhythm, but that rhythm might be changing. The steady drumbeat of institutional capital could be starting to overpower the metronome of the halving. Prominent investors like Cathie Wood of ARK Invest have been vocal about this shift, stating that she believes the 4-year cycle is being disrupted. Her analysis suggests that as massive institutions move into Bitcoin, their buying behavior acts as a stabilizing force, as they are less likely to panic sell. Analysts at Bernstein have echoed this, noting that the market may now be in an elongated bull cycle with more sticky institutional buying offsetting any retail panic selling. What does this mean for you? First, it suggests that the days of explosive 100x gains from a single cycle are likely getting harder to come by. The market is getting bigger and more integrated with traditional finance. But on the flip side, it could also imply that the soul-crushing 80-90% drawdowns of past crypto winters may become less frequent. This is still a hypothesis, of course, but as more institutional capital acts as a buffer, the extreme peaks and troughs could begin to smooth out. Bitcoin is maturing, and with that comes a degree of stability. The key takeaway is this: the old playbook might be getting thrown out. The strategy of simply waiting for a deep post-halving bear market before buying might not work as it did before. The institutions aren't waiting for the next cycle. They are here now, and while retail investors wait for the perfect entry, the banks are simply dollar cost averaging with billions. Analysts are still bullish, with firms like Bernstein adjusting their targets and predicting prices could reach new highs in the 2026-2027 timeframe, supported by this relentless institutional demand. But the path to get there will likely look very different. So, let's bring this all together. A massive regulatory shift has cleared a path for banks. The first wave, including major players like PNC, is already rolling out products designed for convenience but not for ownership. At the same time, existing independent pathways for Bitcoin exposure, like MicroStrategy, are facing new market risks. All of this is fundamentally altering the market dynamics that have governed Bitcoin for its entire existence. This forces every single person interested in Bitcoin to make a choice. There are now two distinct paths forward. The first is the bank path. This is the path of convenience. It's easy, integrated, and feels safe, but you must understand what you give up. On this path, you surrender control. You surrender ownership. You are not your own bank. You are just another client. Your assets can be frozen and your transactions restricted. This path takes the revolutionary power of Bitcoin and neuters it, reducing it to just another number on a screen in a system they control. The second is the sovereign path. This path requires more work and responsibility. It means learning what a private key is. It means buying a hardware wallet and using it properly. It means understanding the phrase, not your keys, not your coins, not as a slogan, but as the first commandment of this space. This path is the entire reason Bitcoin was created. It is the path to true ownership, to censorship-resistant wealth, and to financial freedom outside the control of any middleman. The choice between these two paths is the most important decision in your crypto journey. The banks are betting billions that you will choose convenience over sovereignty. A series of quiet regulatory letters has unlocked the door for Wall Street. We have seen the blueprint for their control-based products, and we have seen the pressures being applied to the competition. The next few years will define the future of Bitcoin. Will it be a truly decentralized asset for the people, a tool of individual sovereignty, or will it be absorbed and tamed by the very institutions it was built to challenge? The battle for the soul of Bitcoin is happening now, and the choice starts with you. What will you choose? Let me know your thoughts in the comments. Are the banks a welcome sign of maturity or a threat to Bitcoin's original ethos? I want to hear what you think. And if you found this breakdown valuable, make sure you subscribe and hit that notification bell. The game is changing faster than ever, and you can't afford to be left behind. Thanks for watching.